Hello everyone and welcome to our webinar for September. I hope you've all been enjoying the warmer weather we've been having lately. For those of you who don't know me, my name is Kate Salkeld and I'm an associate based in our Sydney office, and joining me today to present today's webinar is Adrian Bailey, who is our managing principal, also based down here in Sydney. And today's topic that Adrian will be looking at today is looking at the consolidated group regime and the types of instances where it might be valuable to implement that kind of structure for a client. And Adrian will be taking us through a couple of different case studies to highlight the advantages of that structure, looking at both where the client is eligible for the small business CGT concessions and also when they're not eligible for that CGT relief. Before I hand over to Adrian to discuss that topic, just a little bit of housekeeping in case anyone is new to this platform. Firstly, if you would like to download a copy of the PowerPoint slides, you are welcome to do that just by clicking on the Files button on the right-hand side of the screen. You'll be able to download a PDF version of the slides from there. If you have any questions that come to mind throughout the webinar, you can feel free to submit those just by clicking on the chat button, and you'll be able to type in your question there. I'll be keeping an eye on those questions, and I will interrupt Adrian at an appropriate time to put those to him, and we should also have some time at the end of the webinar for any additional questions. And the last point to note is that today's webinar will be recorded and it will be later uploaded to both our website and our YouTube channel. So just keep that in mind, not to put any client details into questions if you are submitting those, but also if you do need to duck out in the middle of the webinar, you will be able to watch it at a later date. So without any further ado, I will hand over to Adrian to tell us all about consolidations.
Thanks, Kate. I might not get to tell you everything about consolidations, but welcome everybody. And I see Shane, you put a message in the chat. Good afternoon to you as well. And yeah, Kate and I are both well. Hope the same for you. It's been a little while since I've seen you in the flesh. I hope everything's well with you. Today, we are talking about the consolidations regime in the Income Tax Assessment Act and when it can apply. And we're going to do a case study type approach where we're going to look at a couple of different, well, two different scenarios. And work different ways that we could use the consolidation group to improve an outcome for clients, I should say, as well as having a look forward to some future planning in terms of maximising tax outcomes on future transactions. So it is a complicated area of the legislation. There's a lot to it. However, the majority of the legislation is about what happens when somebody enters a consolidated group or a consolidated group is formed, and what happens when somebody exits a consolidated group. So once you've done everything that you need to do to form a consolidated group, and you've done all your calculations that you'll need to do, which we'll touch on a bit later on, in my mind, relatively straightforward moving on, and some significant advantage by being in a consolidated group. Now, this is not something that you're going to recommend for all clients, I would think, but there may be clients who you'll see as we work through through the case studies, who may have some advantages by considering this sort of restructure. Of course, we don't restructure just for the fun of it, or the legal or accounting fees that come with restructures. But we're usually doing it to improve the position of the client, to lock in some tax concessions while we still can, or to do some planning in terms of long-term goals and long-term succession of the client group. So our first case, or our two case studies today, the first one, you're going to get a little bit of small business concessions as well. In terms of, we're going to have a look at a case study involving a restructure using small business concessions and then the use of the consolidated group regime. And then we're going to have a look at a scenario where a client, either the assets are too large or there's too much turnover and they're just not going to qualify for small business concessions, and ways that we can still engineer ourselves into the consolidated group regime and some of the advantages that may come from that, from an asset protection or other areas. So, jumping into the first one, we do many presentations on the small business CGT concessions. It's an area that we do a lot of work in, do a lot of advice work in. Kate in particular, very knowledgeable in that area. If you do have any questions for clients, I'd encourage you to reach out to her directly because she knows it back to front. She corrected me this morning on a matter, to tell you the truth. And so in the right circumstances, if we're looking at a client restructure, it can be used to reduce a capital gain to nil. And from a mathematical perspective, what we're looking about for a husband and wife type couple is a gain of about $4 million using a series of the concessions and not including the 15-year rule, reducing that gain using small business concessions and the discount gain to nil on a $4 million gain. Of course, in order to use them, we have to ensure that we're eligible. So we will touch on eligibility. But the end result, if we're doing what you would consider to be an internal restructure using the small business concessions, is that whatever we're transferring our asset to, whether they are business assets themselves or whether they are shares in a trading company, which is our example, it's going to result in a market value cost base in the hands of the new entity. So I mentioned the maximum we could potentially deal with tax-free is around that $4 million mark in terms of gain. And certainly when you're getting to that sort of position, I would think in terms of the value of that asset, you're also going to be butting up against the maximum net asset value test of $6 million. So we all know that it's a hard cliff in terms of these tests. Once you pass them, you can't access them. So if you have clients getting into that sort of stratosphere, it may be the reason for them to look at doing an internal restructure now to lock in those concessions. And as we'll see, if we combine it with some consolidations work, there's some other advantages that we can get from that. So legislation contained in Division 152 of the 1997 Act, the Income Tax Assessment Act 1997. Basic conditions in 152A, 15-year exemption. As I mentioned, we won't focus on that one. It is something that you come across, but relatively sparingly because you have to have been running the business for 15 years. Small business 50% reduction, small business retirement, small business rollover. So just recapping on the key parts of the basic conditions, you have to be a small business entity. So that means the entity itself has to have a turnover of less than 2 million, or aggregated turnover, I should say. Or you satisfy the maximum net asset value test. So that's our $6 million test. If we have a look at assets excluding some, such as home, personal use assets that are individually owned, superannuation, life insurance policies, is our net position less than 6 million? Yes. Then we're through on that one. Or if we're dealing with partnerships assets, that's a partner in a partnership, that is a small business entity. And then we also need to satisfy the active asset test. So our asset is held for use or held ready for use or is used in a business of either the taxpayer or a related entity. And there's some ownership period or usage periods in terms of ownership. So at least half of its ownership period or more than 7.5 years if it's been held for more than 15 years. Those are our basic conditions and the things that you return to time and time again as the first step in working out whether a client can access the small business CGT concessions. So jumping into our case study, we've got ABC Proprietary Limited, some very imaginative names I came up with in this presentation. And we have mum and dad who are the shareholders. We say that the value of the shares, so the value of the business, is around the $4 million mark. So what we're going to do in our case study is we're going to transfer the shares for that market value. We're actually going to vendor finance it in this circumstance, and we'll come back to potentially reasons for that. The other option would be to gift it to XYZ, but in this circumstance, we're going to vendor finance it. Now, XYZ, we've established it so all of the shares of XYZ are held by a trust. So if you think about our first scenario, where we've got ABC and mum and dad as individual shareholders. If either of them are directors, then obviously they're going to be at risk, and it's very likely that at least one of them are directors. And so that puts the value of their shares at risk, and then potentially the value of the assets and other assets. So we're, in the first instance, we're removing that risk of that individual share ownership by transferring those shares to a company held by a trust. Now, I recognise, before anyone chimes in on the chat, that if we're vendor financing it, there will be a loan to mum and dad from XYZ. So there is still an asset in their name. However, we're removing potentially part of that risk by transferring the shares over. And in a perfect world, as we work our way through, there'll no longer be that loan there anyway. But the other thing that we're also doing there is we're creating some flexibility in terms of dividends that eventually come out of XYZ. So ABC could declare a dividend to XYZ. It then declares a dividend to the trust, and it can distribute to people other than mum and dad. So we're increasing some flexibility there. It could go, for example, to other companies or other trusts and be used in investment as opposed to going to mum and dad. And we're also creating that dividend trap type structure where we've got a trading company and a holding company. So if we've got excess profits in ABC, we can move it down to XYZ and lock it away there, as opposed to it sitting in the trading entity, which is very likely what has been occurring to date in ABC. Because we've got the sole shareholders, there's a disincentive there to take retained profits out above the 30% tax rate unless they're spending it on other things. And so it's very likely that there's going to be some retained profits building up in ABC in this scenario. Our CGT position for both taxpayers, assuming that they meet the basic requirements, and I'll just go back to the previous slide. There'll be some additional requirements that they'll need to meet because we're dealing with shares, and that's the modified maximum net asset value test. So either ABC would need to be a small business entity, so that turnover, 2 million turnover, or looking at ABC, its net asset position is less than 6 million, which we're going to say it is in this circumstance. And also being shares, 80% of the assets of ABC have to be active assets. So in order for the shares themselves to be active. Also recognising and using the small business concessions, we're transferring shares from mum and dad. So we need to look at the taxpayer. They cannot be a small business entity because they are not carrying on a business. So we do need to rely on the maximum net asset value test. But we're saying that's satisfied in this circumstance. So for each of mum and dad, their taxable gain will be 2 million. If we're assuming a cost base of nil, and just for the purpose of today, we will. Applying the discount gain, the general discount, because they've held it for more than 12 months, reduces that to 1 million. Small business 50% reduction reduces that to 500,000. And then the retirement exemption after that reduces it by another 500,000, leaving our assessable capital gain with nil. This would be our structure at the end of the first part of the restructure. So we have ABC at the top, it's still trading. We haven't had to do anything in terms of redoing contracts with any of our suppliers or any of our people that we deal with or entities that we deal with. We haven't had to renegotiate leases or anything like that. We've got XYZ Proprietary Limited as the shareholder of ABC. All of the shares of that are held by a trust, and it owes 4 million to mum and dad to the value of the share, for the value of the shares. Now, it may have paid out, and maybe the circumstance to use the small business retirement exemption, we need to put money into super. So it actually may have paid out part of that to them, which would have then obviously reduced that debt potentially. And so we've got the situation, but we're saying in this circumstance, it's still owed $4 million for shares. And as I mentioned before, in terms of general asset protection, we've got all the shares held by a trust, which also, of course, increases our flexibility of distributions. And we have our dividend trap type structure or holding company type structure. So excess profits in ABC can sit down in XYZ. And if something happens in ABC, if there's some sort of claim against it, we've secured our retained profits away from the trading entity and trading risk. Now, a further step after this, and obviously today we're talking about the consolidations regime, would be to form a consolidated group. And I'll come back to that diagram in a little. In terms of stamp duty, would only be payable if it is land rich, which we're saying it's not. It only holds business assets, so there wouldn't be no duty payable on the transaction. Not on the slide, but no GST. Shares it's a financial supply, so no GST. So effectively, a tax neutral transaction we've been able to achieve. If we think about the cost base for CGT purposes of the shares, XYZ has acquired them at today's market value of 4 million. We've locked in our CGT concessions now. If there's a future sale of the shares from XYZ, and say if we sell them for $4 million, just to use that as the figure, there'll be no further tax paid on that transaction, and the $4 million will come into XYZ. And then potentially we pay out our loan of $4 million, or pay back our loan of $4 million. So that's a way of extracting that $4 million from XYZ without there being further taxation. But that will only apply on the sale of shares of ABC. And it may not be the case that our buyer is willing to buy the shares. Any lawyer who gives advice to their client in transaction will say, try not to buy the shares because you're buying the history of the company. So it may be the circumstance that all we can get on a future transaction is an asset sale. And how could we improve the tax outcome of that? Well, that's really where the consolidated group regime comes in. Sorry, I'll just go back to this diagram. To form a consolidated group, what we need in its simplest version is one company that holds all of the ownership interests in a subsidiary. And a subsidiary can be a company, can be a partnership, can be a trust. Just depends on how those partnerships and trusts are structured. So with that, if we consider the consolidations regime here, we've got XYZ holds all of the shares of ABC, then it can form a consolidated group for tax purposes, income tax purposes. What that means from an income tax perspective is that it is treated as one taxpayer. Inter-entity transactions are ignored. We submit one tax return. Our financial statements will often have each of the companies obviously still recorded separately, so that you can track different things in different companies. Any franking credits, ABC come down to XYZ on consolidations. Any losses, again, are pooled in XYZ. And so we're effectively still one taxpayer by electing to form a consolidated group. So this would be what you'd call your simplest version of consolidated group. One holding company, or one head company, as it's called in the legislation, holding a subsidiary company. Now, the other thing that happens when you form a consolidated group is you need to reset the cost base of CGT assets in subsidiary members and the head company as well. And to do that, there's a calculation set out, which is effectively 13 steps. And when you do that calculation, you end up with what's called the allocable cost amount. You then apply that allocable cost amount to what are known as reset cost base assets. So they are assets that are not things like cash. You can't reset the cost base of cash. And some other assets are also excluded. But in terms of the cost base of all our other assets, they're reset in proportion in accordance to what our ACA calculation ends up. Now, one of the first steps of the ACA calculation, if I could put it in kind of layman's terms, is what did it cost to acquire the membership interests of XYZ? So in our initial transaction, we've acquired it for $4 million. So that's our cost. The assets of ABC. The shares of ABC, I should say. Getting my ABCs and my XYZs mixed up. And so one of our first steps in our ACR calculation will be a $4 million figure, because that's how much it's cost us to acquire the shares of ABC. When you work through the remainder of the calculations, there's a couple of different other adjustments. A lot of them won't be relevant in this sort of circumstance where we're effectively consolidating straight away after the transaction. They tend to be more relevant when you've had a subsidiary for some time and then you're consolidating. But effectively, what will happen is the ACA will end up at around that $4 million mark. Might be slightly lower, can't be more. And then you will apply that new ACA to the cost base of our CGT assets. So the cost base of the assets in ABC will be reset to $4 million for CGT purposes in our example, or around about the $4 million mark. So if, and I might just move my camera so we can have a better look at this diagram. So say sometime down the track, and again, to make it nice and simple for us lawyers, I'm using the figure of $4 million. A buyer comes along and says, I want to buy your business. You start the negotiations, you say, oh, look, we want to sell you the shares because that's easy for us and that's better for us. They say, no, thanks. We only want to buy the assets because we don't want to take on the risk of what's happened in the group. And so the final deal can only be done as an asset sale agreement. So we've got a sale of the assets of ABC, or the business of ABC, to the buyer for $4 million. If it's at $4 million and our cost base has been reset to $4 million, then clearly there is no tax to be paid at that stage. If it's more than $4 million, then we pay tax above $4 million. We could then move our $4 million down to XYZ, which could use those funds to repay our loan for our original transaction to mum and dad. So as many of you will have found when you're dealing with asset sales in companies, what's tax-free to the company may not necessarily be tax-free when our clients want to get their hot little hands on it, in their personal hands. And so if we had structured it this way, and obviously this takes some planning, it's not something that you would want to do if your client had already started discussions in terms of a sale, it would allow us the ability to access those funds without further taxation, because they're repaying the original loan. And we've had a CGT event on the sale of those shares. So a fairly good result at the end of the day for the client.
Just before you jump into the next case study, a couple of questions, if you don't mind. Yeah, that diagram will be good. First question from Kunal. Is there any particular advantage, or why do you need to have the shares in the head company owned by a holding company and then that entity owned by a trust? Why can't you just have the shares in the head company owned by the trust directly?
Because you can't have a trust as a head company. It can only be a subsidiary. And so you need a structure where you've got a company in its own right that holds the ownership interest in another entity, whether that be company, trust, or partnership. The reason that we have a trust holding those shares in the head company is that asset protection part.
Thank you. And then just a question, is it true that the holding company can be liable for the debts of its subsidiaries? So, for example, if there's a claim on ABC, could that have an impact on XYZ?
It could, if you could show that there was insolvent trading occurring. And so where you have a company holding all of the shares of another company, if there's insolvent trading in the trading company, so a subsidiary, then the holding company can be liable for that, but only to that extent.
Thank you. And last one for now. Could we elect a particular subsidiary as the primary taxpayer in a consolidated group?
Not as far as I'm aware. It's always the head company that's filing the tax returns.
Yeah, I guess you could have that supplemented by a tax sharing agreement. I'm not sure whether you're touching on that.
I'm not, but I can, that you've brought it up. So what Kate's mentioned, because we have one taxpayer for the purposes of the tax legislation now, XYZ and ABC are not seen as separate taxpayers. If ABC doesn't pay its tax bills, so it'll still have things like, I'll get away from GST because that's separate, but if it has a tax liability that it hasn't paid, then XYZ can be chased by the ATO, if I could put it that way. One way to get around that is to have, and the legislation allows you this, is to enter into a tax sharing agreement, which effectively says that if it's a tax liability of ABC, then ABC is solely liable as opposed to XYZ, and each member of the group is responsible for their own tax liabilities.
Thank you. Sorry, just one more snuck in.
Mm-hmm.
So in the case where the shares in ABC were already held by a trust, just confirming we would still need to interpose that holding entity to create this structure or to have this sale.
Correct. In this circumstance, because you want that $4 million part of the ACA calculations. But yeah, you would need to interpose that, plus you need that holding company.
Thanks, Adrian. That's all I've got for now.
And probably just on that, Kate, while I'm thinking about it, you'd probably use a new trust in that circumstance, nice clean skin trust as opposed to the old trust, looking at, kind of the rationale of why we're doing this other than tax reasons. We're changing trust to something else because we want to make sure that it's clean and it's not exposed to other assets, like those sorts of things.
Yep. Thanks, Adrian.
All right. Now, what if we can't use the concessions? So this is our second case study. And so this is the scenario, we've just been through one where we could use small business concessions to reduce the size of the gain. If we can't use them, could we still restructure so we use the consolidation regime and we get those sorts of advantages that we've just been through? Potentially, yes. There's some issues when you use rollovers and then you later consolidate a group for income tax purposes, and I'll come back and touch on those. But what we could do is we could do some steps beforehand, which will also increase the client's asset protection in terms of those assets, but also get away from any sort of nasty tax stings in the tail when we consolidate. So our second case study is different. We have a trading company. The market value of the business that it operates is $5 million, and it has a building in the same entity, which it runs the business from. I'm sure you've all seen this before. Not great from an asset protection perspective, but people will buy assets either where they can get finance or where their trading history is or where the money is, and that's what's happened in this circumstance. Again, we've got individual shareholders, mum and dad, and our company's name in this example is Square. And as I mentioned, we've got business of $5 million and building of $6 million. So a couple of issues off the bat. Again, we've got a mixture of assets here. We've got a business asset, we've got a building. Not great to have them in the same entity. Mum and dad are shareholders. No flexibility there in terms of dividends. Presumably, if our building's worth $6 million and we're paying market value rent, there's a reasonable amount of funds moving around in this company. And so with that, sorry, I should say we're not paying market value rent because it's in the same entity, but if we've built up this sort of asset base, clearly our business has been profitable, so it's very unlikely to have had retained profits, so very likely to have had retained profits. Again, that issue with whoever's the director, also the shareholder. So not great. It is what it is. It's the way the clients have been structured. It's what they've done. But is there a way that we can fix it? And yeah, there is. Our first step would be really to protect the value. And so in order to do this, we would set up a new company, which in this case we've called Square Reserve. All of the shares of that are held by a trust for our asset protection reasons. And we would then enter into a transaction where Square would make a gift of effectively the value of the business and the equity in the building to Square Reserve. So a company can make a gift, can do anything that a natural person can do. Of course, as part of your documentation, it would be prudent that it gets the consent of the shareholders in order to make that gift, because it's giving away value. We're not moving the assets themselves, so we're not having a taxing issue. If you've ever seen presentations on what we do for personal asset protection, it's somewhat similar to that in concept. The assets are staying where they are. We're making a gift of money equal to those amounts. That's documented by bearer note. Square Reserve receives that, then lends it back on that third top arrow, if I could put it that way, under a loan agreement, and takes a PPSR over the assets of the business and a mortgage over the property. We've also got a further arrow there, a dividend. If we've got retained profits in there, we may want to issue some sort of dividend share to a Square Reserve, take those retained profits out to Square Reserve. And again, that would form part of the amounts loaned back to Square. So what we've ended up with in this situation is we still have Square, it still has mum and dad as the sole shareholders, but it has now got a secured loan to Square Reserve, potentially equal to the value of the business, the building, and any retained profits we've got sitting in Square. In doing that, we're now in a much stronger position if anything were to happen in Square in terms of some sort of event down the track. Now, recognising there are timing requirements in Corporations Act in terms of things like unreasonable director-related transactions, undervalued transactions. So there's a 4-year period after we enter into this transaction before they would be safe from those sorts of clawbacks. But we are looking at protecting that value. It should be protect as opposed to project. Protecting that value in Square by moving that value over to Square Reserve without any tax consequence, except for the potential of there being top-up tax on the dividend if we're taking a dividend out of retained profits via a dividend share. The end result of stage one, and if that's all we do, if all the client is concerned about the asset protection aspect, is our Square Reserve is a secured creditor. It's first in line, value is protected. It is, however, crucial if we then enter into the world of consolidations. And why may we want to do that? Well, this is where we get into the second part. So in order to move into the consolidated regime, as I mentioned, we need at least one head company and then a subsidiary. So using rollovers, so it would be a 615 rollover in this circumstance, we would interpose a new company, Square Holdings, in between the shareholders of Square. And so what we end up with, and I have it on the next slide, is we have Square still running the business, still holding the property, all of the shares of which are held by Square Holdings, and mum and dad are the shareholders of that. So we still have that issue in terms of dividend flexibility, moving them out. We still have the issue of mum and dad being perhaps directors of Square. That issue that was flagged recently about one company owning another in the presentation. And yeah, if we're insolvent trading in Square, then potentially that's at risk. But also recognising that we've moved that value away and Square Reserve is a secured creditor. So it's not ideal, but it's the best that we can do in this circumstance without triggering out too much tax. Now, CGT is not so much an issue in this circumstance. We've got a rollover. As I mentioned, depending on the rights of our dividend shares, there may be top-up tax between 25 and 30% that's paid in the reserve company on the amount of our dividend. Depending on the state, we may qualify for corporate reconstruction relief. Now, in some states, such as New South Wales and Victoria, corporate reconstruction relief is only partial relief these days. And why we need that relief from stamp duty is because we've got a land-rich entity here. Square holds a $6 million building, so it's land-rich. So if we're dealing with the shares, we need to make sure that we qualify as best as we can for that corporate reconstruction relief. Otherwise, we're going to have a large stamp duty bill on transfer of the shares. For New South Wales and Victoria, that partial relief is effectively 10% of the value of what you would have paid on stamp duty if it was charged at full rate. So what I mean by that, if, for example, we didn't get reconstruction relief and our stamp duty bill was $400,000, then if we got reconstruction relief, the bill would be 40,000. So it is still a cost and still something that needs to be considered, particularly with a value of 6 million. But it also, in this sort of circumstance, would be useful for other reasons, which we'll come to. Now, our next step is we want to protect the building as fully as we can. And so with that, we may want to consider moving it out of Square into another subsidiary of Square Holdings that we could establish. So in this case, if you haven't been to many of our presentations before, a triangle for us means a trust. We're going to move it to a trust called the Square Property Trust, but that could also be a company. It doesn't have to be a trust. And depending on the state, if we're looking at that corporate reconstruction relief within the Duties Acts, it may have to be a company, but in this example, we're going to use a trust. So we could establish Square Property, a trust. As I said, a trust can form part of a consolidated group as long as the only members of that trust is other members of the consolidated group. So that could, for example, be a unit trust. For land tax purposes, we may want it to be a fixed unit trust. Or it could be a version of a discretionary trust where the only other beneficiaries are Square and Square Holdings. Just depends on discussions with the client and what they want to do moving forward. That, as I said, could also be a company. One of the advantages of having the trust there is members of the trust, control of the trust can be held outside the group. So it may be something that we're looking to do as some form of succession planning. The control of that trust could be held by the kids. Not going to do anything in the short term because it's still in the one income tax consolidated group, but if it ever does leave it, then potentially there's some advantages there. Now, when we move the property, do we need to think about tax? If we have formed a consolidated group, no, because the single entity rule applies. Stamp duty, same scenarios with the shares. There's potentially stamp duty relief, but only partial relief in some states. So again, it's a cost to consider. But if this is a consolidated group here with Square Holdings, Square and Square Property forming part of the consolidated group, the movement of the building itself will not lead to any income tax consequences. So it gives us the ability to move that building away from the trading risk and have it sitting in a separate entity. Again, if we're forming a consolidated group, we need to run through our ACA calculations. Now, if you remember from our first example, one of our first steps is, well, what has the head company paid to get the shares? When we're using a rollover, that figure is really nothing. It hasn't actually paid anything to get the shares. I know it has to issue shares, but when we work through the calculations, that figure is going to be nominal. So that could cause us a problem down the track, because if we get to the end of our ACA calculations and our ACA is less than the historical cost base of the assets, then we end up with a taxing event on consolidating. So that's not a great position to be in and not what that we want to be in. However, if we've done our asset protection steps first, one of the steps requires us to take into account liabilities to external parties. Square Reserve will be an external party, it's a non-group member. And so that liability of approximately $11 million or whatever it was will be taken into account in the ACA calculation. So what we end up with is our building is away from our risk. We've moved it over here. There's potentially stamp duty in some states, or partial relief, I should say, in some states. Our retained profits are sitting down in holdings, they're away from risk. Because of the take-up of the liability and the ACA calculations, the cost base of the business would now be at roughly market value. The cost base of the building would now be roughly market value. So we're having some significant advantages there moving forward if there ever is a sale of the property. But we're also achieving those other reasons and goals for doing such a restructure in terms of moving the building away, retained profits, having a structure where we've got our retained profits sitting somewhere else, and achieving those goals as well. So something that ticks all the boxes, I guess you could say, in that circumstance. One thing though to remember is that we don't have a loan out to individuals here as we did in the first circumstance. So if we do sell these assets, okay, it's tax-free in here. Sorry, I shouldn't say tax-free. It's taxes paid above our market value that we're resetting. But if we take that excess out from Square Holdings, it will be taxable in the normal way. So good for your initial tax outcome, but then you need to do some planning in terms of, well, potentially we leave those funds there, we invest in other assets, whatever the client's needs are at that stage. But important to remember that it's not that same scenario as our first example where we can then get the funds out tax-free to the individuals. So 2 options there. There are further variations and further options. As I mentioned, you could have a variety of different entities there. But if we're sticking and we're meeting the legislative requirements and making sure that the end structure meets the client's objectives, that's the hard part. Developing that plan, making sure that we're thinking 5-10 years down the track about what they're potentially doing. But it is a situation where we can look to maximise the end game for clients in terms of the potential tax outcomes, as well as achieve those some of those asset protection goals now. Kate, any more questions? Hopefully easy ones.
I only have one for you. I wouldn't say it's easy, but you can give it a shot. Question from Rory. Are there any issues in forming a consolidated group where a script-for-script rollover was initially used in interposing the parent head company?
Yeah, that comes back to what I mentioned in terms of that sort of first step of the calculation being, what did we pay for it? We're using script for script. You're going to have a pretty low figure there. So that could be a situation where if you just did it and didn't think about other things, then you could have a taxing event on consolidation. So you've got to be careful in that circumstance. Anytime there's a rollover being used in the client's history or group, you really need to dig into that and then look at other things that may be taken into account for the ACA or ways that you could address that so that you're not having an issue on consolidation.
Thanks, Adrian. That's all I have in terms of questions for right now. But if anybody attending thinks of any questions in the coming days, you can feel free to contact Adrian or myself with those questions, and we can come back to you separately. But just a couple of closing remarks before I finish off the webinar. As always, we will be circulating a feedback survey by email later today. If you wouldn't mind just taking a couple of minutes to complete that, that would be appreciated. You can enter in there any topics that you would like to hear from us in future about. Having said that, we do already have a topic in mind for our next webinar. We will be looking at a recent case that came out from the Federal Circuit and Family Court of Australia. The judgment was only handed down quite recently on the 30th of July. And without giving too much away, the court was effectively looking at some discretionary trusts that were established with the beneficiaries limited to the direct descendants or the bloodline, if you will, of a particular individual. And good news for all of us that have been using trusts for asset protection purposes. The court effectively determined that the structure was effective and that the assets of the trust couldn't be subject to a family law claim. So in our next webinar, we will be looking at the facts of that case and the determination of the court there, and just overall looking at the effectiveness of discretionary trusts, or in particular our bloodline trusts, for asset protection of future generations. So if that sounds interesting to you, please keep an eye out for an email on our next webinar, and we hope to see you there. Just one other thing to mention, hopefully you received a separate email on some recent legislative changes that have occurred in Queensland, where under the legislation, the maximum perpetuity period has been increased from 80 to 125 years. However, whilst that's in the legislation, it's not actually an automatic change, and we do still need to implement that extension by way of variation to the trust deed. So if you do have any clients with a Queensland-based trust, there is a link in the email to my calendar, where you can book in a time to discuss with me, or you can send me an email, whatever you prefer. But we would be happy to conduct a review of those trust deeds, firstly to make sure that we can extend that vesting date within the trust, but we would also be happy to conduct just a general review of the terms of the trust, just to make sure that it has all of the normal provisions that you would hope them to in 2025. But other than that, thank you all for joining us today, and we hope to see you at our next webinar. Thanks, everyone.